CCI, the Commodity Channel Index, invented in 1980 by Donald Lambert for trading commodity futures like corn, wheat, and oil. So if you're using that in crypto in 2026, that should tell you something. Every candle on a chart has 4 prices: open, high, low, close. CCI uses 3 of them: high, low, and close. It starts by taking those 3 values, adding them together and dividing by 3. Let's call this the current candle score. It's one number that represented what happened in that candle. So if the last Bitcoin candle had a high of 100,000 and a low of 95,000 and a close of 98,000, add those 3 numbers together and divide by 3, the current candle score for Bitcoin would be 97,667. One number per candle. Now we take the last 20 candles and do the same calculation. So you have 20 candle scores. Then you take those 20 candle scores and run a 20 SMA over them, which, as you already know, is those 20 values added together divided by 20, a simple moving average. And you have a single value each candle. Let's say that average comes out to 95,000. So now you have 3 numbers: the current candle score of 97,667, the SMA 20 of 95,000, and when you subtract one from the other, you end up with a gap. And that gap would be, in this case, 2,667. Stay with me. So the gap means nothing by itself, this 2,667. We don't know if that's a big move or a small move. So the CCI indicator normalizes that. Now, what does normalize mean? It's like one scale to rule them all. Whether you're trading Bitcoin or some coin a bloke invented last Tuesday worth half a penny, the scale would end up being the same. Normalized. Now, how does it do this? It does this by dividing the gap, are you ready, by 0.015, multiplied by a mean deviation, another maths expression. Deviation's very easy to understand though. It's just the average of how far each of those 20 candles wandered away from that 95,000 SMA value. Some close, some miles away. The average of all the wanderings of the price action over 20 candles. The result finally is the CCI value. One number on a scale. Above 100, price is significantly above its recent average, or overbought. Remind you of anything? Below minus 100, price is significantly beneath its average, oversold. And that's it, the whole indicator. Maths is finished. But before I go to the charts, there's a whopping big problem here. That 0.015 constant. Donald Lambert chose that number in 1980, so that roughly 70 or 80% of CCI values would fall between 100 and minus 100 under normal market conditions. Normal market conditions in 1980 for corn futures. Nobody's ever changed it for crypto. Nobody adjusted it for a market that can go up 10% before breakfast. Nobody asked if those overbought and oversold levels have any business being applied to a 24-hour global asset crypto market in 2026. They just copied the formula into the indicator and stuck it on TradingView. That constant is 46-year-old and nobody modern day is giving it a second thought. Let's get to the charts. 3 examples. First, look at this overbought. The theory is in CCI that if it's overbought, you can go short. But look at this. Overbought down here, kept going up. Let's look at the second example, oversold. It went from oversold to overbought, and the price stayed within a very tight range. Now you know what I'm going to say next. Let's stick on some institutional context. Oh my lord. Back at number 1, said it was going to go down. Look at all those bullish order blocks. No wonder it went up. Go to number 2. Oversold. It was in a bullish breaker block. Support was right there. That wasn't going down at that point, was it? Now here's my favourite example. Overbought, overbought. All saying go short. All the time the price is going up and up. CCI has no idea. It was just measuring distance. Lambert designed this for the commodities market, not crypto trends, which are volatile and dynamic. You are using a corn futures indicator on crypto, and it's probably costing you. CCI is not broken. The maths are fine. The problem is context. It's measuring one thing: how far price is from its recent average expressed as a normalized number. And those thresholds, 100 minus 100, were calibrated for 1980s commodities futures. One number, no context. Borrowed from a corn futures trader who's been retired decades. You might not be surprised to learn that PulseFlow doesn't use CCI. Not because the maths is wrong, but because measuring distance from a 20-candle average tells you nothing about what the institutions are doing or where price is actually going next. Pulse flow tells you why it moved, where it is going next, and when you might be able to get in. CCI looks at distance. Pulse flow looks at intent. Okay, if this has changed the way you look at these indicators, please subscribe, like, and share. I do a video on this every week. You can watch one of my other videos down here, and I'll see you in the next one. Bye-bye.